For being here. Let's make sure everyone gets in real quickly. There's probably some speakers who are not taken off mute. Sorry about that. I'm going to ask everyone who's not speaking to actually go off camera as well. Sorry that that setting didn't work. So a very good day to you all. Welcome. Some more people. Okay, we're back. Very good day to you all. Welcome to the Wall Street Blockchain Alliance's Crypto Investors Summit 2020. For those of you who don't know me, my name is Quaranta, chair of the Wall Street Blockchain Alliance. I'm very excited to share this time with all of you. We've got a great series of panels of thought leaders in crypto assets and financial markets. We're going to spend a lot of time discussing both the opportunities as well as the challenges of this kind of evolving world of crypto asset management and investment. I'm going to have to mute some folks. Apologies. There you go. Alrighty, so first bit of housekeeping for today's event. This webinar is being recorded. If you are not a speaker, be on mute and be off camera or you will be made to leave. Sorry. All attendees will be, with the exception of speakers, will be in listen-only mode. Throughout this virtual event, we will also be sharing polling questions with the audience. So please do avail yourselves of that. We're looking forward to feedback collectively. All attendees are also encouraged to submit questions for each panel using the Zoom chat function. We'll reserve time at the end of each panel for Q&A and then some time at the end of the event as well. And now to kick off, let me introduce the chair of the WSBA Crypto Assets Working Group, a good friend and colleague, Mr. David Brill. David, how are you, sir?
I'm great, Ron. Really excited to be moderating this panel with you and excited to share this combined knowledge of our panelists as we kind of look into what's coming in 2021 from really a multi-dimensional angle of both from the valuation side, the legal side, from practically speaking, how we implement a broader crypto ecosystem and, you know, all the challenges and bright lights that we have looking forward.
I think it's interesting, David, you and I have been having this conversation about crypto assets, and we had planned to spend a few minutes kind of introductory conversational. All of our speakers and panelists, we've been to this rodeo before, so it's always a great conversational series of panels. But I think for me, David, I wanted your opinion on this, and I know we have some data sets as well to bring up in a poll. There's almost been this uneven evolution. We keep talking about institutional engagement in crypto assets broadly, and it feels like it's a conversation you and I have been having for several years. And in my opinion, what I've seen is a lot of retail engagement. I know I have a young niece, for example. I have a bunch of colleagues who have children who are involved in Robinhood, for example, and now buying crypto. What have you seen in the landscape? Let's talk a little bit about what that retail versus institutional landscape looks like a little bit. Let's talk a little bit about the data as well, and then maybe we bring up the first poll for everyone who's dialed in.
Great. Well, you know, it's really a bifurcated market, as you mentioned, from that perspective. From the retail side, there's really a lot more optionality. Retail investors aren't constrained by certain things that institutions are constrained by, whether they are investment advisors and 40 Act regulations, whether they're broker dealers and 33 Act regulations, whether they're institutions where they need to work with a party that knows who all their clients are. You know, when we talk about know your client KYC and AML.
Yep.
So I think the retail options are really more robust, and you see them in different flavors. So one flavor you see them in is the traditional crypto exchanges. And so you see them with the Coinbases of the world, Bitflyer, Gemini here in the US. And then you see, you know, overseas exchanges like Binance, KuCoin, and some of those exchanges. So you really have a multitude of options. And those multitude of options I'm talking about are in the centralized exchanges. And in addition to the centralized exchanges, you have the booming decentralized exchange market. And in that market, for those who aren't familiar with that, those markets are really peer-to-peer. It's sort of the evolved Napster of trading, but now for crypto assets. And so there are many decentralized exchanges, and some of us have been using them for a while, but in the last 6 months, DeFi has become more mainstream, and these options, you know, manifest themselves. There's Uniswap, there's a number of them, Curve, Dodo, a number of them where people are using, where it's really peer-to-peer, where Ron, you and I could literally trade assets, crypto assets through this platform. We wouldn't know it's either of us, but we'd be trading on this platform. So whereas you have this real wide expanse of options for retail, institutional investors have really been more limited because of 40 Act regulations, 33 Act regulations, KYC, and AML.
Yep. And I would argue there's the limitations of the institutional limitations because of regulations. I would also argue, and I don't know how to say this, particularly in retail, but also institutional, the UX is a bit problematic. And I think one of the questions we kind of review is, what are the UX challenges associated with engaging in the crypto asset market? What I'd like to do, David, if you're comfortable, let's kick off the first poll, if we could.
Yes, let's do it.
Okay, let's launch this poll. And the question is, do you currently own or have you custodied a crypto asset besides Bitcoin and Ether? And David, I know you and I spent quite a bit of time. Yes, no, and then you always provocative, prefer not to answer.
I'm sure you know the answer to my question.
We'll give it another 30 seconds or so. It'll be interesting to see everyone's perspective. I want to know who the 7% that prefer not to answer are. I know we've got some of our speakers showing up a little bit late as well. Speakers, if you're a panelist and you showed up, please stay unmuted. That way we can make sure we capture your opinion and perspectives as well. We'll go a full 60 seconds. 74% of the votes are in. David, an astoundingly large percentage own or have custody. And I almost want to ask you, what was your thought around saying or asking, have custody of crypto? Talk a little bit about that from your perspective, because I know you're deeply involved in this as well.
So when I think of it, I really think of two flavors. There's ones where people are actually holding the crypto assets in their own wallets, whether it be a hard wallet or, oh, here we go, 69%. Interesting. So Ron, out of the 55 respondents, some people were shy and didn't jump in. 25% basically said no, that they didn't own a crypto asset besides Bitcoin or Ether. And I think in some measure, that really goes to the fact that there's sort of a comfort level with the big cap, we'll call them crypto assets. But, some people are not as comfortable with the, they call them altcoins, although some of the different tokens are so large right now, I hesitate to call them altcoins. But it's just interesting. But to go back to your question with regard to custody versus owning, and I kind of view it in two flavors. Like when you own crypto assets on an exchange, the crypto exchange is really holding on to those tokens. And, some could argue you don't necessarily own them, that the exchange owns them and that you sort of have some interest in that ownership. Whereas when you're custodying them in your own wallets, you really, not only have you acquired them, but, they're in your personal possession. Yeah. So that was the reason why I made that distinction.
Which goes back to something you and I have often talked about, which is this kind of UX issue, right? What does the UX need to be for that level of engagement? I know you and I and everyone on this call, we could probably say wallet in the context of crypto assets, and we know what we're talking about. If I grab my elderly mother and tell her to get a crypto wallet because she bought Bitcoin, she will have absolutely no idea what I'm talking about. And I think that's true even in the kind of professional class of financial services still. Is that your experience? Is that what you're seeing as well?
Yes. It's very difficult for people who are not computer savvy, and even those who are computer savvy, but particularly who aren't, to engage on some of the platforms. I think the public, and I'll say, since we're based here in the US, the American public has gotten very used to the E-Trade, Fidelity, TD sort of model, and seeing how you purchase, buy, and sell, stocks. And the UI UX for many of the crypto exchanges certainly haven't evolved to that point. Some have matured and become easier to use, but there's still a reticence among people to use some of these other exchanges. And so there's one thing there. And then as you kind of go deeper into the ecosystem, the DeFi exchanges, there's definitely, if you want to stake a token or mine, it becomes very difficult. It's not intuitive. There are a number of steps you have to go through, and there's always some concern, if I do the wrong thing, will my tokens go away? And it's really not intuitive. And I think it is still a barrier, years later, to getting people comfortable using those platforms.
Yeah, understood. And what I think might be good right now, you and I often talk about the comparatives of crypto assets, right, David? So crypto versus, we hear this in the news a lot, right? It's crypto versus gold, crypto versus equities, crypto versus whatever. And we've had these long, detailed conversations around correlation analysis. I wanted to bring up a chart that our partner Brave New Coin shared. And Rory, I think you're on the line. So if you wanted to kind of interject here, I think it might be worth sharing with the audience
Sure.
ENC's comparison of key markets. And hopefully everyone can see that. David, Rory, speak a little bit to this comparison. Tell us what it's based on, what are your thoughts, and what's it reflective of over time?
Well, just to explain the context here. So this is simply a price comparison, price movement or price performance comparison year to date, having based all these asset classes to zero at the beginning of the year. So what you're seeing is that at a high level, large cap, our favorites here, Ethereum and Bitcoin, have very much outperformed traditional assets. And you can see that by, the NASDAQ, gold and S&P 500. But I think what is happening now is that Bitcoin is going through a rally. The Ethereum story is slightly different. Ethereum is a beneficiary, if you like, of the whole DeFi experience, because it's the fundamental asset on which all the other DeFi assets and trading is happening. But the Bitcoin story now is that it's decoupling from the other markets, particularly equities markets, whereas for the most part of the year, post that pandemic surge in the first quarter, Bitcoin has now broken away again from the equities markets. And that story about is Bitcoin the new gold is, I think, one that continues to play out, but it takes on a different feature at each point in the market in terms of what's it telling us about correlation there.
I wanted to let me touch on that real quickly if I could, because we're already getting questions, Rory, and we're not even at panel one. Are you and the team seeing this decoupling with other altcoins as well? Like, it's a conversation we've had a lot. What are your perspectives on? Let me bring up the chat again. I'm so sorry. The other altcoins, are they decoupling in the way that Bitcoin is, or are we starting to see a falling out of the altcoins that aren't worth the time from the financial markets perspective, and really the worthwhile tokens are sticking around?
Yeah, I think, look, it depends on your perspective, but I would say that's definitely, there's tier 1, 2, and a long tail tier 3. So tier 1, the top 5 to 10 assets have largely remained consistent in terms of their rankings. You see a bit of movement. They have their own correlation to the rest of the pack, but then they have their own correlation, perhaps separate correlation, maybe to other assets, classes, sub-asset classes in crypto. There is that saying that when Bitcoin and Ethereum in particular increase, all boats rise on a rising tide. But we don't necessarily see that because there are some contrary movements. DeFi has been flavor of the month, but is probably being hammered by some technical issues that have led to some hacks. And that's raising a question mark over some of the DeFi assets and their performance. But I think there are, if you look at the top 10, there is a solid pack there that is emerging. It's like your Premier League, sorry for the soccer analogy, but there's your Premier League that by and large are going to dominate. There'll be a tier 2 that may come in and out of that top 10 pack on and off. And then there's an extraordinary long tail tier 3 assets, which probably shouldn't have even been issued, but never mind, we learn to live another day. And I think then there's more thesis emerging from the clustering, and it's about the use cases, it's about the adoption, and it's also about the network effect of some of these tokens. And that could be subject to a whole different discussion. But the decoupling is mostly crypto versus other asset classes, and then clearly within crypto, some stratification of clusters of crypto. And the final point I'd say is obviously with a lot of new assets, once they're launched, if they get a lot of hype, there's a lot of speculation. But as we can see, that it doesn't take much for some of those speculative assets to quickly dissipate after initial froth, particularly if they're subject to a hack or some other issue. So it's yeah, it's very much a three-tier game, I think.
David, anything you want to add? I do want to, once we're done sharing this, I want to bring up the next poll as well.
Yes, I do. There are a couple of things I want to add. I think really notable is that, you know, things have, we've been in a very turbulent year, and that's an understatement. And even though there might have traditionally been a flight to quality, and you might have seen that in March with the downturn in the crypto market in March, but what you're seeing is even in these sort of unstable times, Bitcoin and Ethereum have really become assets that people are more comfortable owning. So as you can see, you know, through these last 6 months, you've seen an acceleration in the price of Bitcoin and Ethereum, even while there's this instability in the markets. So if these assets weren't more mature assets, people would typically be putting their money in safer assets and not be willing to be as speculative, you know, considered to be in speculative assets. So here, Bitcoin and Ethereum are becoming more mainstream, and, you know, people are talking about allocating in them, especially in a time where there's still uncertainty in the global economy.
Great, thank you, David. Thank you, Rory. I know we did talk about pulling you in that early during our back and forth with David and I. I'm going to stop sharing now. I think it might be worth the time right now, David, unless you have an objection. Let's do poll number 2. So this one with David was the DeFi conversation about staking or mining tokens on a platform. It'd be interesting to see. So for so many of our industry colleagues in this space, when I bring up DeFi, there's still a handful who have no idea what I'm talking about. And that's kind of reflective in some of the stuff we're seeing here. This is here. And again, I always want to know the prefer not to answer person. I just want to know their reason. So we'll give it another few seconds. David, talk a little bit about some of the mining and DeFi platform work that you've seen. I know you've been pretty deeply involved. I know you have colleagues involved as well. Would love your thoughts, and kind of let's level set what we're talking about when we say DeFi, if you're okay with that.
I'm happy to. You know, for starters, I've advised, you know, both on a strategy and a legal level, some of the DeFi platforms. And what I really like to think of it is, it's really an alternative way to earn yield while you're owning a specific crypto asset. So as we know, we're all, you know, in this low interest rate market environment. And, you know, some of the, if you put money in the bank in your savings account, you're probably getting less than 1%. You know, DeFi has opened up an ability through various levels of interest and sort of like risk perspective. Very interesting. So our poll came back, and 78% of the poll members have not mined or staked. And you know, Ron, that just goes back to the point made before that, you know, the UI UX is daunting. And especially people worried about fat fingering or just making some data entry mistake, and then their token sort of, you know, disappearing. So this is really, it's really an evolving space. But I mean, the beauty of DeFi, and to explain it quickly, again, it's just, you know, in a marketplace where you can earn different yield on different tokens, either through supporting the ecosystem by staking your tokens onto the ecosystem and using that liquidity so that trades can be made, or helping sort of fund the engineering of the platform by, you know, helping mine additional tokens. But one of the beautiful things I think we'll see over the next couple of years is the ability, using these decentralized platforms, to, you know, the ability to exchange one token for another. So right now, these decentralized exchanges, and then I'll go back to DeFi, allow you to take, you know, Ether and turn it into Bitcoin. Well, not Bitcoin, but Ether, and turn it into another ERC20 token. So literally the thousands of ERC tokens, you can trade one pair for another. Pivoting back to DeFi, what's really interesting about it is that you can take a stable coin like USDC or some of the other stable coins. You can deposit those on these platforms and get outsized returns. You know, and some of these are on insured platforms. So you could see 7 to 10% returns on owning a stable coin. And where a lot of people are chasing yield, this is a way to do it. You can do it that way, or if you're a believer in Ether and Bitcoin or some of the other tokens, you can hold your token, put them on these platforms and earn a yield while you continue your holdings.
Perfect. Thank you. David, I know we're a little bit early. We still have a bunch of questions queuing up. I don't want to digress too much away from the panel, though. So if you're all comfortable, I'm happy to turn over panel number 1 to you, David, if you want to kick off, introduce your panelists and give them an opportunity to kick off the session.
Sure. So when we think about the glue of this panel, it's really about what does 2021 look like? And we're really taking this from a 360 degree perspective. We're looking at it both from a valuation perspective, a DeFi and new product development perspective, what it looks like to really use crypto assets in the marketplace, and then from a legal perspective, what opportunities and challenges do we see in 2021? Now, I'm a little biased because when we talk about legal, we always think of it as challenges and sort of slowing us down. But I like to think of it also as opportunities to get more clarity and to allow additional people in the market. So what I'm going to do is I'm going to briefly introduce each of our panelists, and I'm going to do it in order of their speaking, and then we're going to just jump right into the panel. So our first speaker is Boris Richard. Boris is a managing director in forensic and litigation consulting at FTI, based in Washington, D.C. He focuses on crypto, blockchain economics, and token valuation, and his practice includes representing companies as far as digital asset-related investigations, undertaking the course of private lawsuits or regulatory inquiries and enforcement actions. Dr. Richard complements his expertise in crypto with over 20 years of experience in fixed income trading and investment management and economic and litigation consulting. So Boris really has the ability to look at this as a trader and also as an advisor to entities who may be involved in litigation. Our second speaker is Dr. Alexander Lipton. I'm sure many of you know Alex. He's a co-founder and chief information officer at Scylla. He's a visiting professor and dean's fellow at the Hebrew University of Jerusalem and the Connection Science Fellow at MIT. He is an advisory board member at numerous fintech companies worldwide. He has a very long biography, but I'll summarize it to say that in addition to all that, Alex was awarded the first ever Quant of the Year award in 2000 by Risk Magazine. He's published 8 books and more than 100 scientific papers. Our next speaker is Howard Krieger. Howard is a managing director in CBIZ Valuation Group, LLC, and he has over 20 years experience. He specializes in the valuation of fixed income securities, alternative assets, ABS, and collateralized obligations. He's a former Big Four senior manager responsible for a variety of assignments, including intangible business valuation, IP valuation, financial modeling, and valuation of equity instruments and other exotic financial assets and liabilities. His perspective will be very interesting, in particular with regard to how do you value from an accounting or just a valuation perspective, crypto assets. So I think that will be a real helpful addition to the group. Kayvon Sadeghi, last but certainly not least, is a friend, as all the panelists are, is a litigation partner at Schiff Hardin here in New York, focused on securities as litigation, SEC investigations, and other complex litigation. He's also a tech enthusiast with a programming background before law, and he's been representing clients in the blockchain space since 2016. So we've got a lot of brain power here. I'm excited to work with everyone, and we're going to just jump right in. And Boris, it's been an explosive year. We just showed that chart from Brave New Coin showing, Ether up over 200%, Bitcoin over 100%. We've moved, we're not so correlated with the market anymore. What do you see as you stare into 2021?
So, quite a bit of interesting stuff, I would say. On the one hand, I believe that the volatility in the crypto space will be, relatively high. Because on the one hand, and I think quite a bit of it will come from macroeconomic factors. So on the one hand, if you have a sizable stimulus from the government across the world, so there will be quite a bit of liquidity pump into the economies, and so people will continue especially on Bitcoin as the alternative gold, as an inflation hedge. So on the other hand, there is a double.
It looks like we've got a bad
and,
connection with you, Bar.
the equities, collapse or equity. I'm sorry.
It looks like we've got a pretty bad connection on your side.
Let me double check. I can try to switch the network. Just a second.
While we're waiting for Boris, I think the volatility is something he'll go into a little more. And I think that's something that concerns people, that they view crypto assets as much more volatile than traditional assets. So when Boris gets back online after he finishes talking about his initial point, that's another thing that we can parse out some more. Because it feels like the less volatile people feel that crypto assets are, the more comfort they may have.
Okay.
Going back to you, Boris.
Yeah. Can you do you see me now?
Yes.
Okay. All right. So from my perspective, I believe that the volatility will continue to be high. I mean, if you look at the options implied volatility on Bitcoin right now, it's 77%, which is probably 20 points higher than it was for most of the year, except for the March and April crisis. And the volatility will be high for, I believe, for two reasons. A, because of the macro factors. On the one hand, you have a potential expansion, continued expansion of liquidity, inflation fears, Bitcoin being purchased as an inflation hedge. On the other hand, if there is a double-dip recession and equities, go down, and given that from a correlation perspective, the cryptos, start looking more and more as a high beta tech stocks within the S&P 500, there is absolutely a possibility that they will go down together with stocks. So in addition to that, I mean, the volatility will probably be driven by the fact that there will definitely be more over regulatory scrutiny for the DeFi world. So because, it's obvious that there is a wild west at the moment in the DeFi space, and people realize that they need to be AML and KYC compliant. But just like there was a regulatory crackdown on ICOs in 2018, there will definitely be more regulatory scrutiny in the decentralized finance space. And we know that the crypto prices are fairly sensitive to the regulatory actions being taken. So secondly, I believe that there will be more investment opportunities and alternatives in 2021. I mean, we have already seen that happening in 2020, but there will be more to come in 2021. So on the one hand, now you have a handful of investment opportunities in DeFi space, right? You can earn fees through joining the liquidity protocols. You can, obviously yield farming will still be prevalent, albeit it's not going to be as rampant as it is today. The mining contracts that they're very popular at the moment. I mean, if you look at the Genesis trading, they are out, Genesis mining, they're out of the mining contracts. So the demand for mining is fairly high. You have staking, investment staking, which, takes quite a bit of a prevalence in the world. So you will have more tokenized investments, right? So, I mean, there was news of Flusang Exchange, issuing a tokenized $3 billion bond for China Construction Bank a few days ago. So people are playing more and more in yield enhancement strategies to the extent that there are Bitcoin options. They're starting, doing strategies that involve covered calls. So that's sort of a yield enhancement strategy that typically happens in a fixed income world and equities world, but now we can see that happening in the crypto space as well. And again, there will be more personalized index related stuff. Yes.
So, as we talk about that, when we talk about the idea that another big stimulus will be done in the US at some point, it seems to be a consensus around that. Do you think people will be looking at Bitcoin and other cryptocurrencies as an investment option, as the dollar, as we see much more printing of money in our system?
I believe so. Yeah, because in the end, the supply of Bitcoin is limited to 21 million units. So, and yeah, in the back of the mind, and especially given that you have sort of supporting statements from big names in the investing community, you know, the big hedge fund managers, Walter Jones, that came out with the announcement in May, Druckenmiller more recently. And from that perspective, given the limited supply in Bitcoin, or rather, you know, we know it's 21 million coins and no more. Yes, you know, definitely people will be looking at that as an inflation hedge.
And what do you see institutions just buying in the spot market, or do you think that they're really going to wait until, or the majority of institutions wait until their sort of traditional products, whether it be a Bitcoin ETF or some other product that they're buying into? Which path do you see them taking, or would they buy spot cryptocurrencies and wait, or how do you see them, you know, walking into the market?
You know, I think for the moment, the institutions are dipping their toes. It's solely for now in Bitcoin. You know, clearly, given the high volatility, the institutions are not touching any altcoins. There are some institutional investors in some of the index products that are proliferating. So we know that the Grayscale, you know, Bitcoin Trust reached 10 billion because they hold half a million Bitcoins, about 3% of the total supply. So I think there will be more investment in the Bitcoin space, possibly in Ether, because there are now some Ether futures that are traded on designated contract markets. And institutions know that Ether is not a security, it is a commodity. So from that perspective, and there will be probably, you know, somebody will be tipping their toes in other ETNs and exchange traded products. Not in the United States, there are no ETPs or ETNs in the US, but there are more and more, you know, exchange traded products in cryptos in Switzerland, in Germany, actually even in Canada, I believe in Canada. So, but outside of the US, it will be mostly spots. To some extent futures, to the extent that they trade on regulated markets, and there are a few of them right now, but definitely not in altcoins. The volatility is way too high.
Boris, I'm hearing that the audio is still a little garbled on your end, so I'm going to migrate over to Alex, and then we'll come back to you a little bit later on.
Sure.
Alex, very happy to have you on our panel. As we think about DeFi, can you help our audience understand a little bit, you know, what DeFi is and what you see as its future going forward? And, you know, if you want to weigh in on the UI UX conversation that we started, I welcome your thoughts on that as well.
Yeah. Okay. Thank you, David. You know, it's a pleasure to be here. And, you know, my take on DeFi is that it's an interesting kind of emerging movement, if you wish, which is partly a reaction to the fact that the mainstream economic environment is very inhospitable to people who are interested in savings, right? So interest rates have been pushed relentlessly by central banks worldwide to pretty much unprecedented levels, you know, like at least, you know, 60% of the government bonds, of all the government bonds in the world are traded at negative yields. We are truly living through, you know, very, very unusual times. And, you know, this idea that negative interest rates are indeed, you know, commonplace, it's very, very strange. The last time when interest rates were seriously negative were in the Middle Ages, right? So it's something very unusual. So, but practical situation is that savers are, of course, at a major disadvantage, and so people are desperate for yield, and they are in particular look for decentralized finance, right? So decentralized finance, of course, is not for the you know, faint at heart, because you know, it's unregulated, and it is built as a next You know what? May I suggest we put people on mute because otherwise there is a lot of noise. No. So anyway, so since it's built at a level above the foundational level of blockchain, we really are facing real possibilities of hacks, and they're essentially inevitable. Whilst the foundational level at which Bitcoin is built have proven to be pretty much impervious to any attempt to hack it at the level of the protocol itself. Of course, you know, everything which is built on top, it's not having a seal of approval of the founding fathers or mothers, you know, Satoshi Nakamoto and the rest. And so many exchanges have been hacked, and all the people think many people at the individual level have been hacked, but the actual paradigm of you own your secret key, you own your Bitcoin, had never been challenged. Whilst with distributed finance, given its complexity and secondary nature, it's certainly open to this type of manipulation and hacks. However, those people who are, you know, comfortable with this can probably earn, in many instances, oversized returns, right? So one of the areas where I think there is something to at least look at is automated market makers, right? So automated market makers, as you, David, were alluding to, if you feel that you want to keep your position in two sister coins, so for example, a USDT and a USDC, for instance, or even say Ethereum and the USDC or something, then you can in fact become, quote unquote, an automated market making by putting your money, you know, staking it and waiting for anyone who comes to algorithmically take some of the coins in exchange for others. In general, you know, there is a lot of colorful language around all this. So, and people should bear in mind that being a yield farmer is not necessarily such a great thing. So, for example, the greatest of all chemists, Lavoisier, lost his head being a yield farmer. So, of course, it happened 200 years ago during the French Revolution, but who knows what can happen now. But the point is that, you know, the language is somewhat deceptive. What is called the impermanent loss can very easily become a permanent loss, because the nature of this instrument is that they actually have negative convexity. And I'm sure Boris, as a former trader, and probably other people will appreciate what I'm saying. So essentially, you lose money whenever things deviate from the equilibrium, and then you make money on transaction costs. So whether or not it's a sustainable operation remains to be seen, but clearly some of the people who design these things feel that like 5 to 10% return, which is of course unthinkable in normal economy, is too low in this crypto economy. So they try to design automated market makers, which are even more kind of dangerous than the conventional constant product ones, and so on and so forth. And it's not unusual to read a white paper where somebody would say, you know, like this particular schema only gives 10%, so why don't we beef it up so that it gives 300%? Whenever you think that 300% is an interest paid on your investment, forget about it, just from general consideration. But in general, I would say this is a very preliminary first stage. What I do think potentially can happen is that you know, the holy grail of capitalism, trading, settlement, and trading and settlement of securities, right? So that can potentially switch to decentralized finance. So that is a very, very lengthy process and quite complicated. But in the future, we can see decentralized exchanges for conventional equities and stuff like that. But this is a remote possibility. Right now, we're going through the growth pains and stuff like that. So, but it's interesting, very interesting idea.
So do you feel that there are rudimentary elements of it that can be sort of adopted in the near term that could be more widely distributed? I mean, I think I can think of one platform that has insurance that allows you to put, stable coins and some of the larger assets in it and receive a yield. It's plain vanilla by DeFi standards, but I think it is a place where people could get yield and hold their assets in a regulated, insured environment. Do you feel like that part of the ecosystem?
I think so. I think so. But I would warn people that everything which promises a 50% return and so on, just forget about it from a general perspective. No trees grow to the sky, and no yields grow to 50%, right? So what I do think can potentially be happening is like staking and things of that nature is a viable direction, but basing a major platform like Ethereum on the proof of stake proves to be elusive. Let me put it this way, right? So it's far from being a done deal. And but you can say I put my money, I provide consensus by virtue of having some asset, pretty much like a conventional economy, being a shareholder. If you can find some stock which actually gives dividends, let me point out that all the tech stocks do not pay dividends, so it's sort of not dissimilar to what we see right now. But yes, I think staking is another possibility if people manage to solve the problem of proof of stake as a viable consensus provider. Huh?
Okay, thanks for that, Alex. Boris, let's give you a chance again. We were just talking about staking and DeFi. Let's pivot to Ethereum 2.0. And as many people know that there's an opportunity now to stake on the Ethereum chain, the Ethereum 2.0 chain, as it begins to get rolled out. Ideally, enough Ethereum will be staked so that we can so that it can move forward at the end of November. What's your thoughts about that? Technologically speaking, or just even from an investment perspective, staking your Ethereum on the platform, getting a return, but having it locked for a period of time unless you are in a broader staking pool. Oh, you're on mute. Boris is on mute for a minute. I'll just add for the folks that aren't familiar, Ethereum 2.0 is being rolled out shortly, and as part of that, a certain amount of Ethereum has to be staked on the Ethereum network. So there's an opportunity now for people who want to stake on the Ethereum network. If you stake 32 Ethereum, you can be a node on the Ethereum chain. Boris, are you unmuted now?
Yes, I am unmuted right now. Yes.
Okay, great.
Can you hear me?
Yes.
Can you hear me?
Yes.
Okay.
Go ahead, Boris.
Well, I think okay, and I hope you can hear me. You can hear me better now.
Yes.
So staking is definitely a value proposition in the crypto world. I mean, if you look, Ethereum is one of many staking opportunities that are currently existing. The delegation will definitely be taking place to the extent that they don't need that many ether to be able to stake. But Ethereum is not the only platform that allows staking returns. There are about 150 assets right now that allow staking. And I looked at the statistics that it was so far in 2020 there were about 31 billion in dollar terms that are being staked. And when you look at the returns of about 20%, anywhere between 15 to 20%, even when you adjust it for the inflation rate, you're still getting double-digit real sort of returns from staking. And that's why I'm not surprised that the staking is now being more and more sort of the mainstream passive investment return that people are looking at, and that will clearly include Ethereum as well. So exchanges offer. Yeah, go ahead.
No, I was just going to ask you, do you see institutions some of the more forward-looking ones, maybe creating a node and staking their own Ethereum or using an entity to do that? Or do you think it'll still be through exchanges or through, not for the Ethereum staking, but through exchanges? You know, have you seen institutions go on their own?
Right. Well, I think institutions are increasingly using sort of the third-party providers that offer the staking services, right? I mean, there are quite a few of them in Europe. There are some of them that are popping up in the United States, like you have Stake It in New York, right? So you don't have to be an individual and you don't have to be trading on an exchange like a Binance, well, Coinbase or Kraken or KuCoin if it's offshore. So you have some, solutions. Some of the wallets offer built-in staking opportunities. There are dedicated companies like Stake It, which is based in New York, and I am also familiar with, a relatively new up-and-coming company which is called StakeCube. And StakeCube is a sort of one-time shop solution. It allows you to stake through their wallets multiple tokens. Plus, you can also trade. You can also, you can also do even the mining contracts. So there is more and more of those solutions where where investors can definitely access different investment, potentials, including staking.
Now we're going to migrate on to Howard now, but I will have a couple of questions for you regarding what sort of things we need to look for in 2021 as the trading environment continues to evolve. Great, Howard. So we've had, Boris weigh in on sort of where different tokens sit in the ecosystem, from a perspective of investing and what people are looking at in large and small cap. Alex talked about the evolution of DeFi and different structured in products and how we have a ways to go, but there is some platforms in place. So Howard, what do we need to do to get merchants and day-to-day people running businesses to use crypto and to make it part of the payment ecosystem?
Sure. Thank you very much. And first off, the sound check. Can you hear me okay?
Yes.
Excellent. Thanks again. And I appreciate the opportunity to be part of this storied panel. It's a fantastic opportunity, and welcome everyone taking their afternoon to join. So as a valuation professional, one of the things that I've seen happen over the last decade or so of my experience in the role is when people think about value, they think about a point in time. They think about a price. They think about the yield I can get, the amount today. And what tends to kind of get eclipsed in this discussion and focus on the now is that all of those numbers, rates of return, value, are really nothing more than a forecast of a benefit stream reduced by the risk associated with realizing that benefit stream. So when we talk about the value of a token, even Bitcoin, what we see happening with it is really the kind of summary, and price and return is typically a poor summary of just an expected future benefit brought forward. The two elements that really drive value, whether it's DeFi and staking, whether it's the cryptocurrencies, or just blockchain technology in general, really revolve around, and you brought it up, David, at the intro, the use case and then trust. And the big kind of governor on all new technology that comes to market and new instruments, it's really a function of, what's my guess about what the value, like what's the guess as far as the benefit stream goes, and what's the risk of obtaining it. The use case, so the key in my mind of getting folks to adopt the cryptocurrency is you have to de-risk from both sides. The adoption process has to be de-risked, which we see with big vendors coming on board, and names that we trust beginning to play in the space. You know, if someone I trust does something, then on a de facto basis, will trust it. And to the question directly about how do you get merchants and the like to then adopt the use of the currency, we have to focus on the use case. Certainly, no one running a business it wants to make a decision that's going to increase their risk without a commensurate return. But also the use case can't be more difficult than what they're currently doing. So if I'm a merchant and I'm dealing in fiat currency, to accept or transact in a cryptocurrency, I may not pursue that avenue unless I really think the implementation of a crypto platform is really going to increase my sales. But if my bank or my middle market lender or my vendor has a platform that uses cryptocurrency and it's easy enough for me just to transition over to it, I'm going to do that. And so it is the use case eclipsing the current way we do things. Creating a seamless on-ramp is going to be critical. I want to bring up something about the staking that was mentioned. You know, we talk about staking right now in DeFi with respect to investor benefit. Like, hey, if I stake or if I buy these altcoins, I'm expecting someone else to pay more for it later. I think the value is going to go up. But what's interesting is if you think about how banks work, banks borrow short safe and lend long risky. And in order to borrow short safe and lend long risky, they don't just borrow 1 month money. They don't just take customer deposits, which are very floaty and fungible, and make 30-year mortgages. They actually have a whole line of termed debt and what have you that on a weighted average basis equals the term of what they lend against. And so what I think one of the benefits of DeFi and staking, and something that we're going to see, this gets into the 2021 a little bit, but the benefits of staking is that where folks are locked in for different terms, you create a term structure for the cryptocurrency. So if someone is locked in for 2 years, 3 years, 5 years, 6 months, a term structure of debt essentially is formed, and the good DeFi players, the ones that have a use case for DeFi in the staked environment, are going to leverage that term structure of locked in crypto and develop products, really business to business or merchant to merchant, that take advantage of the liquidity being locked up. Do you follow that?
I do. I think that's a great sort of macro explanation. I think that's helpful to people. Let's dig into the weeds. Let's say I'm a technology company. I'm a believer in the space, and I want to offer payment in crypto. Let's say Ether or Bitcoin, just because those are the largest ones, or maybe a stable coin. Are companies able, do you feel like a company of scale could do that, in January?
It's interesting. I think what you'll find is the CEO and maybe the COO are going to be gung-ho, let's do it. They see the brass ring and they want to grab it. They know that there's value to allow payments in crypto. I think your CIO, your CTO, your information officer, and your technology officer are going to say, what's the integration challenge? And frankly, if the integration to allow for crypto payments is anything more than a button click for an API or an SDK integration package, there's probably room, and there are currently vendors out there that can take your traditional fiat payment system and bolt on that crypto payment platform. There's an opportunity for those entities that could make traditional payment streams, fast forward. But the key is for the merchant, it has to be de-risked. if people are paying in Bitcoin, and through some tracing technology, it was found that 3 trades ago that crypto was in the hands of some terrorist somewhere, there's always that risk that the Treasury Department could freeze that portion of the token. And frankly, you might have been just, selling lollipops or printer paper, and all of a sudden now you're under investigation, by the CIA, NSA, et cetera. So I think that the key to increase value and increase adoption is it has to de-risk all over the place. The perception, am I going to get in trouble if I start to transact in this because the rules are still moving around? As those elements start to get addressed and cured, court cases. I remember, I know he's not on I don't think he's on the call, but Mike Cagney, the founder of Figure and SoFi, we were talking about real world backed crypto products. And I remember something he said to me was, hey, it's going to be like it's going to take a decade of court cases around the world to prove that as a crypto holder, you have recourse against a real world asset for really large scale adoption. Because people want to know, if I'm going to play in this space, what do I really have in my hands? Do I have a risk? Am I taking on a risk by playing in crypto? Or do I have something that's as good as the almighty dollar? And so I think that answers the question, right? That we have to de-risk the space in order to increase adoption.
Okay, so it seems, again, it's sort of a bifurcated environment where retail holders are willing to hold different assets and they don't have the same level of risk or concerns that an institution might have. I mean, if I buy 20 Ether on a decentralized exchange, nobody's coming after me for that 20 Ether, even if my counterparty may have been suspect in the future. But
David, you have a day job, right? If you went into your day job, if you went into your CFO and said, hey, I got a great client, he's going to pay in Ether. Now, I don't know, maybe your firm is set up to accept it, but what kind of response are you going to get? Are you going to get, oh yeah, that's as good as money? Or is it going to be, well, oh gosh, gee, oh gosh. And that little bit of hesitation, really a marginal utility function. Fear creates this marginal utility function. And I think that's the key. When you could go to your CFO and say, hey, this guy's going to wire over Bitcoin, and they say, fine, here's our wallet. That's when you know the time has come.
Okay, well, I'll say for the record, for me, the time has come. So if my clients can pay me in Ether or Bitcoin or stable coins, but again, I'm not a Fortune 500 company. This has been great, Howard. As we talked about risk, I want to pivot over to Kayvon. As we think about risks and sort of risk to the ecosystem in 2021, or maybe clarity to the ecosystem in 2021, as you stare into your legal crystal ball, Kayvon, what are you seeing as big events in 2021 from the legal side and things that our audience should be paying attention to?
Sure, and I hope everybody can hear me. And obviously, thanks for having me. It's great to see you as always, David. I agree with most of what Howard just said. I touched on a lot of legal and regulatory risk sort of issues, and I think all of those are very present. I think one of the things we will probably see in 2021 is more action from a regulatory enforcement perspective in DeFi. So far, this last year, DeFi expanded very rapidly without a lot of enforcement action that was visible above the surface. That doesn't mean there hasn't been enforcement action going on below the surface. And I think we're probably going to see some of that percolating up. I think a lot of the DeFi protocols have been, operating in the US or sufficiently touching the US so that they're on the radar of US regulators. I think they have essentially taken a we don't need to comply attitude to a large degree. I'm very confident that the regulators disagree with that. And so I think we will see some action on that front. A lot of DeFi seems to start from the legal premise that we're somehow not subject to any of the rules as long as we decentralize and some key metric that they decide is sufficiently decentralized. Obviously, that comes from some statements by the SEC, not any particular binding statements or law or anything else. And I think there's a lot of concern that a lot of what we see is DeFi is, as one of the other lawyers in the space has said, is decentralization theater. There are a lot of things that look like decentralization, but when you dig into how some of these platforms actually work, how they've actually been managed, how who's actually deciding what happens to the code, how concentrated is the voting, things like that, it's not clear that they're as decentralized as one might think. And so I think we're going to see a good amount of shakeout of those sort of issues in 2021. I think the same way in 2018 we saw a real crackdown on the ICOs. I think we're going to see some real action in the DeFi space coming up. I think another key point that was just made by Howard is it goes to sort of the AML KYC concerns, and particularly as now values are moving up again, and as you start to get into the institutional, this is sort of the confluence of these different trends. As you start having more institutional adoption, as you start having just more value because the coin values are going up substantially, and with the added volatility, I think it's going to put an increased focus on all the AML and KYC concerns. I think we've already seen that with BitMEX this year, and the government takes some of the other issues they can take their time on and may not seem to take as seriously, but when it comes to those issues, I think as we saw in the BitMEX case, that's where you start dealing with with DOJ and the criminal laws, and the government takes those issues very seriously. I think that's going to be something we're going to see more of this coming year. And until we have solutions for that, I think there is going to be a lot of hesitance for, while there may be people investing in Bitcoin and things that don't present quite the same risk, I think real adoption, on a broader scale is going to be hard for mainstream companies. I think maybe the flip side of that.
Let me jump in there for a sec, because you're making an important point. So do you think that we'll see a sort of a bifurcated regime of exchanges that are going to have a nexus to the US and counteract with US investors or US residents, and then some exchanges that decide that they don't want to be regulated in the US and really take all their nexus out of the US? And I'm not sure how you could prevent US residents from trading on a decentralized platform, but the platform being totally offshore and having no nexus.
I do think there's going to be that sort of bifurcation, but I think the same way we've seen in the more conventional markets, big money globally trusts the infrastructure and the protections that the US markets put into place. And so money from around the world will flow if structures develop that comply with US law and provide the de-risking that goes along with that. Then larger scale, more mainstream money from globally will likely seek out those players, and that the same way Coinbase and Gemini and Paxos are sort of seen as more of a gold standard in their areas because of their regulatory compliance. I think Paxos is a great example of that. They from day one have built sort of regulatory compliant from the ground up as their business model, and they sort of see that as their moat, so to speak. That is their differentiating factor compared to some of the others, and they've been very public about that since they first launched. And now you see the partnership with PayPal and how that's developing, and it's the regulatory compliant path that leads to that sort of mainstreaming. And I think ultimately a lot of the big benefits will flow that direction. And so I think it's going to lead this coming year. I think we're going to see this tension continue to play out that we started to see in the last year or so with the sort of counterculture ethos that Bitcoin and blockchain, crypto in general grew up in, confronting this sort of mainstream institutionalization, and how do you bridge that divide? And we've seen that historically repeatedly. I mean, we all remember when Apple was countercultural, and that was their their selling point and their ethos was, they were the anti-IBM, or Google had the do no evil, that they were the counterculture to a Microsoft. So I think we've seen this story before, and at some point, in order to go mainstream, that shifts and the value will follow it. But I think we'll see a little bit more of that playing out. Maybe just one other thing to mention on that is that, and I'm not going to delve too far into the political, what to predict on politics. That's above my pay grade. But as you know, David, we were down almost exactly a year ago. We were down in DC trying to educate people on Capitol Hill about what's going on, and we were partially just trying to, one of the hurdles is just having people care. It wasn't big enough. It wasn't, people just didn't have the bandwidth to really devote any attention to this. Some people did, obviously, but part of the education mission was just keeping it on the radar. I think that is shifting, and I think one of the concerns that we were raising a year ago about, this is going to happen, whether it happens in the US or not is a separate question, but it's going to happen globally. And so just where is the US's role in a global landscape, and are we doing what we want to do to make sure we have a leading position? I think now that's becoming more evident to everybody. This is growing. The institutional adoption will take care of some of that interest level, and then we're going to be, I think it's in the last week or two, Brian Brooks, who's acting control the currency, was raising some issues about the role of, the degree of China's control over Bitcoin. And when you look and you think about the amount of hash power in China as opposed to other places, and how I think there's going to start, as there's more institutional adoption, as there's more interest from a broader mainstream and the value goes up, I think the sort of global political dynamic is going to start, coming to the fore a little bit more, and you're going to have a lot of people wondering, who controls this, who benefits from it, how much value in these things that are going up is tied up in places that we are otherwise trying to sanction or control, and what are the ramifications of that. It's been too small yet. I mean, we've been talking to the CFTC and others, and this is just a blip on the radar of the total markets they regulate. They couldn't compare. But as it gets bigger, I think we're going to start to see a lot of these concerns come to the front.
Yeah, and you bring a good point up, because when we went last year, there really was a sliding scale of knowledge when we talked to different representatives and senators' offices. Mm-hmm. And I do think that we do need some more regulatory clarity in order to not incentivize projects and different initiatives going offshore. I do think that we are still not as hospitable to projects as they are offshore. And, I do note, I take your points very highly, Kayvon. I do note that Binance does have the biggest retail share and sort of volume of all exchanges, and they've managed offshore for a number of different reasons. So I think there's this, I really see a retail versus institutional pull, where we're going to have some very compliant exchanges that will deal with the institutional space. And then we're going to have other exchanges that will be serving the retail space and will work within either the US regime or will work in another country's regime. And so I think we'll continue to see that play out over time.
I might suggest we go to trifurcate instead of the bifurcate. I think there is the sort of institutional and the retail, as you're saying, but so far we've been dealing with niche retail. And I think mainstream retail is just a whole different category. I mean, I think it's one thing to have these, people can go offshore and jump through VPNs, and people can yield farm if they understand what they're doing and are willing to pull out their, hard, their cold storage, and that whole market is inherently niche. It will stay niche, and there will be a segment that serves that. I think the mainstream adoption portion, the things like PayPal coming online, there's a whole different market that is retail, but is mainstream retail. And I think that's what we are going to see starting to develop, and is really going to look very different than either the institutional or the niche retail that we've seen so far.
Yeah, and I think that's a fair characterization of splitting up the retail pool. And I think you have one Bitcoin trust out there that I know people buy because they can buy it in their, through a traditional broker. But I think that development, whether it comes in the form of an ETF or other sort of structured product, will make it easier for broader adoption. Ron, I know we've been getting a bunch of questions coming in, and you want to take the lead and start throwing them out there.
We have, David, thank you. I will. I'm going to mute out some folks. We've got a bunch of questions coming generally for the panel, and some also directed very specifically to individual panelists. Let's start the first question for the whole panel. And David, I know you're probably going to yell at me when you hear this. For everyone in the audience, anything you're hearing in this webinar or from the WSBA, none of it is recommendations or investment advice in any way, shape, or form. So let's get to that first question. Can the panel recommend the top DeFi staking platforms that they use? And if you are not comfortable answering that, that's okay. But panelists, any thoughts? And I think that means no.
Well,
sorry,
David,
David.
I think
Let me
you're
unmute you, David. Let me unmute you. I'm sorry.
you're on mute, David.
Go ahead, David.
Yeah, for the audience, I'm in a very windy place, so you may be getting a little bit of an echo, so apologies to that. So in general, like I look at it in two veins. I've been using a staking platform recently called Dodo, and you know, it has a funny name, of course, but I've been just trying to use platforms that are just easier to use, and I think it's from a UI UX perspective that you get comfortable. I think all of them, any platform you use needs to have an audit of their code and a security audit. Again, these are sort of, you know, transitional platforms. So that's one I personally use. Other people, you know, the bigger ones are Uniswap and Curve and a couple of others. But I would say that I found the Dodo UI UX to be very easy to use, and it's something that I stake on frequently.
Well, I can jump in. I mean, I use Kraken. Kraken gives you quite a wide selection of tokens that you can, whatever you hold in your portfolio. And some of them are subject to lockups, some of them are not. Like Cardano's are not subject to lockups. So Kraken, again, it's fairly compliant and quote unquote regulated exchange in the U.S. So I can allude to that one as well.
Yeah, I would agree with Boris. Unfortunately, as a New York resident, I'm a Florida resident really now, but for New York residents, that's not available to you. So agree with Boris, just with that. When I wear my New York hat, it's not available to you.
Thank you all. Let's move forward to some other questions. Does anyone on the panel care to comment on what happened to CRED, C-R-E-D, and are any investor assets at risk? That demands its own 1 hour, but anyone care to opine?
Yeah, let me jump in on that simply because of my background in consumer lending. One of the challenges with most of the fiat for crypto lending platforms out there is this notion of hypothecating collateral. It happens all the time at the institutional level, but basically what it means for the folks at home is when you borrow money and you put up a security interest, the lender can represent to you that they're not going to hold your security interest. That when it comes time for it to be there, it doesn't necessarily have to be there. No asset of like value or nothing that looks like it or the assets of the company can be used necessarily as backing the loan. And that function of hypothecation has been used extensively in the fiat for crypto space in order to keep interest rates down. Because if I as a lender can take your security interest and use it to say, I don't know, cover shorts at the exchange where I custody all my security interest. Well, I'm sure that exchange that's custodying the security interest is going to be very grateful that this lending collateral can be used to offset the shorts, and they'll pay me for it, and I can pass that on in lower rates. So there's no such thing as a free lunch. Can't tell you that enough. And if you look at the CRED lending documents, if you look at some of the other, just go out there and apply for a crypto loan. You don't have to hit submit. Read the lending document, and I guarantee you 9 times out of 10, it'll say that they don't have to hold that security interest. And I think the situation with CRED is they just got out in front of their skis, which is very interesting in this environment because of the appreciating value of cryptocurrency. This is a great market to hypothecate in because you don't have a run. But the minute you do have a run, the whole spool unwinds. So that's what you want to be careful for. And I think with CRED, they just got ahead of their skis a little bit.
Great, thank you. Thank you, Howard. I want to be respectful of everyone's time also. We've got a whole bunch of questions coming in and we still have another panel. This is an interesting question. I'm trying to figure out the best way to approach it, or how our fellow panelists answer it. Has crypto custody been solved? And if not, how soon? Good luck, all of you, but panelists, please do let us know your thoughts.
So I'll go with no, not entirely. And when is a very good question, but I think we've seen some interesting back and forth between Wyoming and the SEC and the OCC recently. Wyoming obviously has come out trying to take a lead on these issues, and Kraken, among others, have been pursuing Wyoming as a path, and largely on the idea that there are trust structures that could be qualified custodians under state law, but that would qualify under the SEC rules. And the SEC responded to Wyoming's statements on that front, saying, we're not bound by state regulators, and it's not clear to us that that necessarily qualifies. And that's thrown a lot of people, I think, in the market for a bit of a loop, because I think there's some pretty sound reasoning on why those structures seem to fall within the existing rules. But now it's a question of, do you have to go to a more conventional bank structure instead of a trust structure to gain the blessing of the SEC on that front, or are things going to move to an OCC bank charter platform, and is that really going to be a viable path? There's certainly people trying to open that up as a route. So I don't think it's been fully solved. I think we're seeing a lot of activity in that this fall, and that will continue through next year.
Great. I'm sorry, David, let me unmute you as well. I have to keep doing that. Apologies. But David, you should be back as well. David, you there?
Yeah, I just want to add to what Kayvon said, that so, it's interesting because trust companies, they can be trustees on bond issuances and, very large value. If you look at your major bonds that are floated in the market, there's an indenture trustee, which is the bond trustee. So on one hand, a trust company can be a trustee for a very large amount of bonds, but on the other hand, it's there's a different view when it comes to crypto about whether those same trustees could be trustees and be considered to be able to custody crypto. So it's a very interesting dimensional conversation.
I also think that there are additional aspects which need to be included into the mix. That is, that there are pure technical issues which need to be resolved before this custodial activities can take off in earnest. That is specifically how to custody the actual keys, right? So what are the requisite steps which are needed to keep keys controlling large amounts of crypto and things like that, and what are the sort of legal implications of, for example, losing these keys or being misused, and this is all open issue. I have to say that with all the mind-boggling technical sophistication of Bitcoin, for example, still these keys storage and custody is super archaic, right? So essentially cold storage of keys is pretty much surrender to the ways business has been done 200, 300 years ago, right? You have to write it on a piece of paper, cut it in pieces, store it in several safe boxes, and so on and so forth. So you see what I'm saying? So I think this might be a technical work, but a very important one before things are done in earnest.
Thank you all. We've got two more questions and a comment from a colleague. I have a very specific question both for Boris and Alexander, which is interesting given the content of the conversation. What DeFi yield generating strategies are actually creating value, meaning allocating risk, providing liquidity versus pure play speculation? Boris or Alexander, this was specifically.
Well, I can take a stab on that, and I'm sure that Boris has additional thoughts, but let me start. So I think that actually you have to be paid for doing something, right? So for doing something. So the one possibility is being paid for staking. What would that mean that you provide the service to the ecosystem at large by maintaining its consensus and self-consistency? And for that, you're being paid the same way as miners are paid for, solving hash puzzles. You will be paid for just forfeiting this money for the time being, right? Because you have to stake it for a while. And that's essentially the biggest issue with all the staking ideas, that psychologically people think that blockchains are irreversible, right? So that's sort of immutable, irreversible, and stuff like that. But if you follow the staking path, they actually become mutable, and it had been done before and can be done again. And so that's an important thing. But at any rate, if you stake your holdings, you can earn some return by virtue of actually forfeiting your rights to immediately execute them and stuff like that. So that's one possibility. By becoming an automated market maker, again, you provide liquidity to the marketplace as a whole, and as such, you're being compensated for your effort. Not to mention the very real possibility that impermanent loss, like the authors of these ideas elegantly put it, can become permanent. So you put things at risk and you're being compensated. Whether it's a good enough compensation is a different story, but these are the two main areas where I think that you can actually make some sort of a quote unquote passive income out of your activities.
Alexander, thank you. Boris, I want to give you a couple of moments there, and I do have an expanded question on DeFi that I think is really relevant, but go ahead, Boris.
Yeah, so I agree with Alex. I mean, decentralized exchanges like Kyber, Uniswap, Curve, yes, they enhance liquidity. You're getting paid. You're running convexity risk through this impairment loss, but you're being paid the trading fees, right, as a percentage of a trading volume. I would also mention definitely the crypto lending platforms. Again, the likes, especially the one that want to become sort of AML and KYC compliant. So to the extent that the likes of Celsius Network or BlockFi, can provide, fiat loans that are collateralized by your, cryptos. Again, that sort of serves as a real value. And in addition, some of them look to also engage in prime brokerage business. To that extent, they're basically gluing together the availability of the crypto collateral, working together not only with the retail, but also with some of the OTC broker dealers. Again, that's a real economic function for the markets.
Yep. Thank you. Thank you very much, Boris. And I want to open this last question to the rest of the panel. I want to apologize to panel two. Like every good conference, we're running a little bit behind. This is an extension of that DeFi question. When you look, and I think the total market value of DeFi now is approaching 14 billion or something.
Right.
Is DeFi affecting that kind of process of price discovery when you look at kind of displayed markets, when you look at the quote unquote regulated crypto markets? Is there an impact in that growth?
Is the question whether the price discovery is helped by prices they can see on decentralized exchanges?
Correct.
To some extent, yes, but on the other hand, I think the spillover is relatively limited in my view, because again, the DeFi, interestingly or not, they are. And if you look at the distribution of trades that go flow through the Uniswap and Kyber, most of them are sort of large trades, right? I mean, the number of transactions is governed by small investors, but the value transfer is all between $10,000 and $100,000. Right. So from that perspective, there is a bifurcation. DeFi, even though it's called DeFi, it serves more probably high net worth individuals and family offices. Whereas the crypto exchanges, especially the regulated ones, they're serving the retail. So there's a bifurcation between the two markets, and I don't believe that there may be some spillover with respect to the liquid stuff. There may be some price discovery with respect to the wrapped coins, because the other ones that trade on DeFi. But again, the wrapped coins, there are only a particular segment of the market that trades those stuff, and they're still highly illiquid. So it's
Go ahead, please. Go ahead.
I was going to say, just very succinctly, from a valuation perspective, we like analogies. We love analogies. If we can make a syllogism, we'll jump on it. I think given the disparate risks and the kind of inconsistent and also small sample size of folks in the DeFi space, it's hard to draw and use price discovery in DeFi as a syllogism for other even digital assets.
I would agree with that. And from my perspective, DeFi, all this, for example, Uniswaps and curves and all this automated market maker, are not similar to dark pools and conventional equity trading. They actually are price takers from the public trading place, marketplace, and sort of, you know, transfer it into arbitrage opportunities within this pool. So I don't think that it would be interesting to see a situation when this decentralized exchanges become so prevalent that the mere composition of two coins within a pool indicates the actual fair market price. But at the moment, it's more like arbitrageurs coming from the outside and grabbing what's mispriced and so on and so forth. Yeah.
Great.
I would quickly say that DeFi platforms have first to take care of even the reentrancy problem, because if you look at all the recent hacks that happened already 3 or 4 times, and the reason why people could manipulate the prices, especially of wrap coins, is because they cannot even solve the issue of the bugs in their smart contract that govern the execution of trades. Now, before you talk about robust price discovery, please, take care of that.
Right. So we are over with panel number 1. I want to thank all our panelists. I want to thank my dear friend David. I want to take a little bit of a break. We're going to bring on our new panelists, and while we're doing that, we're going to launch poll number 3. And I'm going to mute all of the other panelists, but let's do this. And give everyone an opportunity. Would you buy a Bitcoin ETF if it was available? And while you're all answering that, I'm going to find my other speakers. Okay. Okay, we'll give it a few more moments. We're at 68%. Vast majority would buy a Bitcoin ETF if available, and I'm always fascinated by the prefer not to answer. We'll give it a few more moments. I think we've got panel number 2 queued up, so as soon as this is done, we will share and proceed with panel number 2. 82% would buy a Bitcoin ETF if they were available. Let me share this with the group as well. All right, so why don't we begin? Thank you, panel number 2. I would do you a disservice to do all of your biographies. So I'm going to turn that over to each of you. Let's begin panel number 2, which was institutional and retail investments, chasing alpha, what that looks like in the future. And really not just an evolution on panel number 1, but really wanted to paint a broader picture of the challenges around the ecosystem of trading crypto assets. We'll talk about the technology and the infrastructure, and we'll kind of overlay that with the regulatory landscape as well. So let me give an opportunity for our speakers and panelists to introduce themselves. Old friend Greg Murphy. Greg, please introduce yourself, say hello.
Thanks, Ron. I'm delighted to be included on the panel. Thanks very much again. Hopefully everyone can hear me.
We can.
Great. I am the Director of Enterprise Development at Polymath. Polymath has been a pioneer and innovator in the security token space for a few years now, having spearheaded the creation of the ERC 1400 standard, and we have now built and are testing a new public permission blockchain specifically for securities. We believe it deals with a lot of what we've learned over the past few years of the deficiencies of Ethereum-based blockchains used for security tokens, largely around identity, compliance, trade confidentiality, and the like. My background is 35 years in capital markets, from the back office, securities lending, derivatives, structured products. I've set up 4 broker dealers in my day, 2 in the UK and 2 in Canada. I may come at this with a little more of a securities perspective, but I think many of the issues that are confronting the traditional investment industry, which I grew old in, are the same as the demands that are required of incumbents of that industry for for the development of capabilities for digital assets. And they're seeing a lot of that demand, especially as the wealth transfer shifts from their parents to younger people. So thanks very much.
Great, Greg. Thanks for joining us. Old friend Kel Canty, please say hello, Kel.
Thanks, Ron, and thanks everybody for being here today. Glad to be a part of the panel. My name is Kel Canty. I'm co-founder of a company called Verity. We've been in the space, my co-founder and myself, since 2013. So I've seen a lot of up and downs in the world of Bitcoin and crypto in general. We actually did one of the world's first audits in Bitcoin. Well, we acted as a specialist in a reporting capacity on the world's largest cryptocurrency payment processor, BitPay. Then we evolved to work with accounting and then also recently tax and portfolio so that we can calculate all of the capital gains and transfers and movements and be able to aid in portfolio analysis and planning from the standpoint of unrealized, realized gains, year-end planning and things of that nature. Work with some of the largest entities in the space, including entire blockchains such as Algorand and Celo. My personal background is in payments since the 90s. Used to go around the world implementing Swift wire transfers, cash management, book transfers, things of that nature with banks such as Barclays, Mitsubishi Bank, ABN AMRO, things of that nature. My degree is in computer science, so love fintech and payments and computers. So Bitcoin and crypto is a natural fit.
So Kel, you and I go back a ways, and I don't think we ever got a chance to talk about, you probably remember filling out the old Swift payment slips at the bank and submitting them for Telex when they were trying to do some of those payments in the early 90s?
Used to write the software that actually made them happen.
Right. Excellent, Kel. Thanks for being with us. Mr. Richard Johnson, old friend, how are you?
Hey, Ron. Thanks so much for having me on here. I'm Richard Johnson. I'm the founder and CEO of Texture Capital. Texture is a FINRA-regulated broker-dealer. We just got our approval back in September to launch the digital securities business, so we can do tokenization of private placements, secondary trading through an ATS, and we are kind of beginning to get going with our launch plan. Before that, I spent about 4 years at a company called Greenwich Associates as a kind of fintech and market structure analyst, where I covered a lot of the kind of crypto and blockchain space, wrote a number of papers on that. And then going back before that, I spent 14 years on the sell side, working on various different trading desks in electronic trading. And really appreciate the opportunity to be here and speak to everyone on this conference.
Great, Richard, thank you. And then finally, Rory from our colleagues and partners at Brave New Coin. Rory Manchi, how are you?
I'm fine, thanks, Ron. Thanks, everyone. So I'm calling this morning or joining you from Melbourne, Australia. This is a very early start for me, but I'll forgive Ron for that. I'm the head of business development at Brave New Coin. Brave New Coin is an established market data and index provider for crypto assets. Been around since 2013-14 and provides indices and market data to a number of clients in this space. I joined the company about 5 years ago now. Previously, I'd spent 10 years with Standard & Poor's, and before that, probably a similar amount of time with Thomson. So I come very much from a market data for financial products and services, fixed income, etc., as well as in Thomson, did a lot of work around regulation and publishing for legal professionals. I guess so. Our perspective is coming from a market data. We talk to all sectors of the industry, and I guess my contribution really be around some of the practical considerations that we see. A lot of anecdotal stuff I can refer to, but also, although we're based here in Australia and New Zealand, Brave New Coin is a global reach company, and so we have people on the ground in Japan, Europe, and North America, and equally, we're servicing clients in those markets too. So hopefully I can bring as well some international flavor to the discussion.
I am never going to live down having you on an early event so thank you all for being here. I've had the privilege of either paneling or being on stage or both with I think all of you. I want to kick off by level setting a little bit, particularly Greg and Kel, Richard, all of us looking at the institutional space which we all come from, as well as Rory, you coming out of Thomson. We're all Thomson, at least colleagues. I think we passed each other in the space. What does the institutional landscape look like today versus what it looked like 10 years ago? Right, Kel or Greg, if we had this conversation, we were talking about something exotic like a crypto asset, it'd be a very different series of conversations. And how has the institutional landscape evolved? And the reason I ask that is, Greg, I very specifically remember you and I had a conversation several years ago, and we'd always say, next year's the year. All of the institutions are going to be involved, and you know, we've seen Fidelity Digital Assets, et cetera. How has it evolved? What does the institutional landscape look like? And you know what, Richard, why don't we start with you? You've been in this space for a while, and then we'll move over to the other panelists as well.
Sure. So 10 years ago, that's going back a long way. That was, you know, no institutional investors were getting anywhere near Bitcoin, or in fact, hardly anyone was. I think you could have picked it up at about 5 cents back then. But the space has certainly evolved. I mean, I started getting into this space. In fact, I remember meeting you at a Bitcoin party in 2015, which was the Toshu days of Bitcoin. The conferences were very different then than they are now. Yeah, there's definitely been a lot of talk about the so-called institutional wall of money coming into the space, and when that's going to happen. I still don't think it's happened. I still think we're a ways away from that. You know, a lot of resistance to crypto assets for a while, even back in 2014, 2015, there was the whole mantra, if you recall, of, oh, it's blockchain, not Bitcoin. And lots of, you know, very well-known people in the space, dismissed it out of hand. We came a long way. I think, you know, the bull run of 2018 was a wake-up call for a lot of people in the space. You know, perhaps a little bit too late to get all the run up there. But I was lucky enough, or, you know, fortunate enough to kind of, when I was at Greenwich Associates, we did a lot of studies on institutional adoption. In fact, we worked with Fidelity Digital Assets on 2 of their studies. And, you know, it was very interesting. I think it was 2018 and 2019 is when we did a study. And there's a big shift in attitudes in that 1 year period. But also, we also found that there's very much openness to crypto in general, which was kind of surprising. I think in the first year, 2018, we found that it was about 20% adoption. And then the following year, it was up to kind of 30%, but that had included Europe. And we actually saw more institutional participation in Europe. I should define institution at this point, because it means different things to different people. What we were looking at then was family offices, was the whole range, but most of the interest was from the family office segments, the RIA segment, so advisors, putting their clients into, you know, crypto assets of some sort, and also kind of high net worth individuals, which are kind of not really institutions, but they've got a lot of money, so they're kind of bucketed that way. And that's definitely where most of the interest was. You know, fast forward, I guess even since 2019 to now, what has changed? Well, you've got some really big players coming into space. Paul Tudor Jones, Stanley Druckenmiller. That's kind of a game changer for the space in many ways. One of the other things we found, when we did the study with Fidelity, was that more traditional, there was obviously the crypto funds, but more traditional hedge funds, it was interesting. They were very knowledgeable about the space, but weren't getting involved. So like your classic long short, or your global macro, maybe global macro a bit more, but your long short, your quant funds and so forth, they weren't really getting involved. I'm going to bet that since PTJ and Druckenmiller have got involved, I'm going to bet that's changed. And then finally, the other thing is that you've got the last crypto boom. Last time Bitcoin was 18,000, I think. The CME was just launching their futures product. That's still going. It's growing. The open interest is growing on that. The volumes are growing on that. And you've had BACT and others come in. That's a much easier way for people to get into the space. And I think that's how Paul Tudor Jones decided to get exposure as well. So the market overall is much more mature. I heard at the tail end of the last panel, there's a question about custody as well. We still don't think we're quite there yet. But that'll be another one of the kind of dominoes to fall on the road to, institutional crypto adoption.
Yeah.
Go ahead, Greg.
Yeah, I would echo that. Thanks, Richard. And thanks, Ron. Yeah, I think adoption is in large part a push me, pull you kind of thing. If all of us remember Dr. Dolittle. People are interested, institutions are interested, but they're reticent to undertake the effort that is required, or even put it up within their own frameworks or in their own funds and whatever, unless they have the ability to show their seniors who are less interested than they are, that that what they hear and read is not actually true. And I think what is happening now is the amount of adoption that is related to demand. And you see that from, again, Richard mentioned family offices and the like, but you're seeing demand again from other funds, and they're looking for a way to deploy assets into this field. It's not going to move the needle in a great deal, but it's almost, I'm not saying it is, but it's almost like when 2 years ago, when you asked a bank, are you into blockchain? And they said, oh yes, we're investigating blockchain. It's almost like you had to say you were there, but you had no idea. And there's only one worse thing than not being there, and that's being there at the time. So in some ways, I think it's kind of like that. And I think we are seeing the proliferation, certainly, of funds, private funds available for people to invest in, or entities to invest in. You're seeing now, you have Grayscale in the States. You've got one existing Bitcoin fund in Canada, another one filed for registration the other day, which is Galaxy Digital. These are listed on the Toronto Stock Exchange, fully marginable, the whole 9 yards. And so this is coming slowly. So I think it is happening, Ron, as we said, 2 or 3 years ago when we first met. But I think infrastructure needs to be built out, and it needs to be trusted.
Yep.
And I think that's one of the things that people don't like to say in this space for various reasons. But no, it does need to be trusted amongst those entities in order for them to continue to investigate and adopt.
Greg, thanks so much. And I do want to give Kel and Rory a bit of an opportunity to speak to this kind of institutional play. And I do want to spend one moment, though. I want to differentiate a little bit, because it's a question that's been coming up through chat a lot in a lot of our attendees as well. We say institutional a lot, and we've been talking about hedge funds, we've been talking about sell sides, we've been talking about some family offices, as differentiated from, and all of you correct me if I'm wrong, I'm not seeing big pension fund moves. I'm not seeing big sovereign wealth fund moves in this space. Let me turn it over to Kel and Rory to comment. You both have institutional backgrounds as well, but let's expand on that perspective of institutional engagement from what you've seen. Kel, do you want to start?
I mean, I will mention that, one of the hallmarks was when the Yale and Harvard endowments, participated. That was kind of a ringing of the bell a little bit for people to kind of stand up and pay attention to that level of, institutional interest and commitment to go ahead and put that out there. In terms of the evolution, just in general, I'm somewhat shocked from, being in the space for a long time and now seeing, even common investment recommendations of 1 to 5% of allocations of portfolio into crypto assets. But I think what's really starting to move the things along, and I know we're going to talk about regulation a little bit later on, but I did want to mention 1 or 2 things in terms of, if the audience isn't familiar with the recent OCC letter that came out, stating categorically that federal banks and institutions can custody crypto and can participate in trading and assisting their clients with that. I think that's a huge movement. I think that's what's precipitated. You may know that a week ago, JP Morgan launched their Onyx division. That is really a kind of separate division for all of their blockchain efforts, including JPM Coin. So that kind of movement is fantastic. And I think it's actually changing the face of everything in crypto. As Richard said, institutions back in the day were VCs like Pantera Capital or Finbushi or somebody of that nature that were getting in, and high net worth individuals. And, it is now getting into institutions. And I think we're going to see kind of a wave effect as it goes into institutions. It will then come back into retail mass adoption is the way I think it's going to happen. My perspective.
Thanks, Kel. Rory, over to you real quickly, and then I do have a couple of questions that I want to expand upon, but would love your perspective.
Yeah, so I agree with most of what the panel is saying. Institutions are not exactly jumping in. They're not just sitting on the sidelines either. People have mentioned Fidelity. Their play has largely been around custody so far, just because their clients are requiring custody services. But then we know they're also building other tools, which I probably can't talk about. Just another perspective on the sort of high net worth individual and how I access crypto products and services. I thought it was really interesting when Cumberland Trading, you'll be familiar with, OTC provider, they suddenly launched an AUD market, Australian dollar market. And I'm thinking, why have they done that? And they put out some data. It's something like 20% of their turnover was coming from Australian dollar customers. And when I drilled into that, that's not your, mass market retail. It's not your institutional pension funds. It was self-managed super funds, what you would call your 401k, but self-directed. And this were people who were entering the market possibly from a trading and a yield perspective, but maybe also to hold. But that was a driver for Cumberland to suddenly open up AUD markets to their customers.
Great, thank you all. Let me peel back the layers on that just a little bit. And we talked about, the panel number one actually did a really wonderful job talking about what I'll call the more exotic aspects of the crypto market. So we heard about yield farming, we heard about DeFi, we heard about staking. Comparing that institutional versus retail landscape, I feel like, Greg, we just got to the point, and Kel, of institutions at least letting us in the room over the past couple of years to talk about crypto. And now we have to go and talk about staking, DeFi, and yield farming. What's your perspective on their level of knowledge in that kind of exotic realm of crypto assets? And given that pace of innovation, will institutional engagement always be a bit behind the curve? That's one of the concerns I have. Kel, actually, can we start with you? I'd love your perspective on that.
Thanks, Ron. And I'd say from a true institutional level, somebody that's at that size, they are now still just grappling with, Bitcoin and Ethereum. They've passed the Hinman test. They are considered commodities. They have, a very straightforward viewpoint of those assets. And even then, we're still lacking a little bit on the custody. So I think at that level, they are not even, looking at DeFi, and they will be behind because they're going to follow the regulators, and the regulators are behind on DeFi, obviously. So I think they're going to stick with Bitcoin, and that's why you're seeing that movement forward. It is classed as a commodity. It's clear regulatorily wise. And that and Ethereum to get you into all of the options that Ethereum bases and gives you is where that's going to be. Now, obviously, we're seeing in hedge funds and some of the more alpha chasing entities, if you want to consider them, fully institutional, they are, taking, say, 5, 7, 10% allocations into staking as one of the more, risk averse type areas of DeFi. They're not getting into flash loans. They're not getting into, yield farming and things of that nature. That's really out on the edge. But we are seeing interest at the hedge fund level for staking because, some of these funds are also doing VC investments. They're seeing the new chains come, and as part of that, they're getting allocations to tokens. And if they're staking, they're going to go ahead and earn a little bit on that. And why not? So the larger institutions, I think, are going to be behind the curve because they're going to be waiting for the regulations. And the regulations are only, 99% clear on Bitcoin and Ethereum. The DeFi world is still lacking in that, and that's going to be a while.
Thanks. Greg, go.
Yeah, I would echo Kel's thoughts there too. The institutions that we've been talking to about staking on our network that is not something that they've even thought of. So I think anyone who is going to participate in staking at this current level, from that side of it, from from an investor that is coming into the space, if you will, is either going to ignore it, or they're more likely to invest in private funds that have staking as part of their investment mandate. Other than that, I think for an individual or for institutional players or high net worths and this kind of stuff to stake, they've got to be very comfortable with the infrastructure to get them there, and very comfortable with the entities that they're staking through. And we saw it ourselves. 78% of the people on this call were asked if they would stake. Now, most of us are smarter than the average bear. So we would be able to figure out how to do this. And 78% of us said no. Where does that leave everybody else?
Right.
So I suspect we're a ways off yet.
So I want to give a little space to Rory and Richard if they want to answer that. And then I want to pull back the curtain a little bit, Greg, on something very specific that you said, and the word is infrastructure. But before I do, Rory or Richard, any perspectives on that last question?
I'm a bit biased here.
Sorry.
So I'm a bit biased here, but I think what's really going to get institutions into DeFi is going to be when security tokens can start coming into the space. So right now you can deposit ETH into a lending protocol and you can withdraw DAI as a stable coin. Well, it's not that much of a stretch of the imagination to imagine depositing a security token into a lending protocol. In fact, ARCA, which is the treasury fund that has been SEC approved, I think they got governance approval from the Maker Foundation to be used as a collateral asset. So when you start having security tokens, assets that are securities but are based on blockchain being put into these lending protocols and withdrawing the stable coin, you kind of have synthetic margin at that point. So you're disrupting what's going on in traditional finance and traditional Wall Street. So I think that's when it starts becoming interesting. And also when you start doing things like having, atomic DVB settlement of a stable coin versus a security token, that then you're doing something that can't be done in traditional financial markets. And that's when I think they start getting interested. Although the counter kind of argument to that is once that happens, it kind of becomes CeFi and not DeFi, if you will, centralized finance a little bit more. But that's, that's the way we walk in this space. The more institutionalized it gets, the less the further it gets away from its roots.
Rory, over to you.
Yeah, I would just say a couple of things. One is on the DeFi thing, it's as much technical engineering as it is financial engineering. And so you've got to be uncomfortable with both. I would also say that for institutions, as we've already alluded to, they need ways not just to custody or to de-risk, they also need better tools for hedging and additional yield. So yeah, futures, options, volatility indices, these are all things that we're working on as benchmarks and as tools to help read the market. And then something that Howard said in the previous panel about lending rates and stuff like that, when you can get a fully expressed yield curve for crypto, then some of these lending and staking platforms will start to have a relevance because you'll be able to benchmark them. Leaving aside the technical stuff, you'll have that yield curve capability, and you'll be able to then build out forward positions, etc., more easily. And that's what institutions need, because that's what they're used to in conventional or traditional assets.
Thank you, Rory. So I want to go a little bit deeper on we use this word a lot in this space. We use it in a lot of our working group meetings. We use the word infrastructure a lot. And it wasn't too long ago, I was having a conversation with a colleague on the sell side, a fairly senior level executive. And I was talking about crypto. I was talking about all the stuff that all of us are involved in on a day-to-day basis. And he said, well, where do you get your end of day quotes from? And it made me realize that this kind of education curve still has a long way to go. What are we talking about when we talk about infrastructure? We've mentioned custody earlier, but I would argue that infrastructure means more. Rory, let's stick with you because you're in this space of providing some of the infrastructure solutions. What do we mean for an institution when we're talking about infrastructure?
Well, I think let's break it down a little bit. On the trading side, in the front office, I think trading solutions for crypto are well evolved, and we're seeing the repositioning of FX software trading and native crypto trading and can be white labeled and deployed. So I don't think that's a problem. Custody, yes, that's still a challenge, but I think as standards and regulation evolves, and Germany has come out with quite some interesting stuff around custody regulations, I think, which are going to be influential in other markets. Where I'm seeing the challenge from an infrastructure point of view, I'll come to the pricing data and just literally portfolio management information, really middle and back office. And here's a classic scenario. We talk a lot to the crypto funds and also the fund administrators because they outsource a lot of the work naturally. When your legacy fund administration platform can't calculate to 8 decimal places, that's a problem. That's a problem. So we're seeing, people trying to address the accounting and tax stuff that's been mentioned earlier. That's fine if your accounting systems can calculate to 8 decimal places. Just simply holding assets in a securities master. What does that mean? There's no QSIP, there's no ISIN numbers. We've created a whole taxonomy in the reference database for that, if you like, a securities master, because I need to know that when you talk about that 3-digit symbol, that's the same that matches up with them in my trading system. So that's what I particularly look about infrastructure at the moment, middle and back office, and it's not very sophisticated or developed at the moment.
Kel, I noticed you nodding your head. You and I have had this conversation many, many times. Would love you to expand upon that. We've had this kind of security master conversation, even the normalization of data. If we're going to talk about institutional or even broadly retail engagement, those are still challenges. Kel, what are your thoughts there?
Yeah, similar to what's been said. When our platform goes through and takes in trade data that we have to normalize. So Kraken calls Bitcoin XBT versus Gemini calling it BTC. You have to handle things out to 18 decimal places for Ethereum, 8 decimal places for Bitcoin, and then actually render that into a fiat value. So when people are talking about close a day, it's actually not that basic of a question. When you have something that's trading 24/7 by 365, what is the close of day? Are you operating in UTC? Are you calling it 4 p.m. on Eastern time zone? Or are you doing something else? And then what are you taking at? Are you take the most recent price? And then if you're under a certain regulatory regime, then you've got to do principal market analysis and figure out, what market did you have that? Because it's not like you can go to the NASDAQ and say, what is the closing price? So, you have the issue of good pricing data. You have the issue of when does it close? And then, was a principal market that had better pricing available for you? And that's some of the things that we're solving right now and reporting on. And it's not prevalent around, and a lot of people aren't aware of the solutions that are out there as it goes forward. So when they ask most people and they say, what's the closing price of Bitcoin? Well, there isn't a closing price for Bitcoin. You have to have software and an understanding in the institution of what that means, and then be able to accommodate that. And that's a little bit of the translation and back office situation that needs to be addressed as the institutions start to get into it, which they are.
Kel, it reminds me, just to digress for one moment, you probably remember a few years back when Berkshire Hathaway went to 5 digits on the exchanges, and a lot of the trading platforms couldn't handle it. I want to say it might be as simple as that, but I think there's more behind it. Greg or Richard, any perspectives you want to add to that as well?
Richard, go ahead.
I got nothing to add here. I think it's a good conversation though.
I'll add something. I think infrastructure extends from what Rory and Kel were saying. I think it extends down a little bit more simply than that, or not than that, a little more simply. In order for the lesser sophisticated fund managers, individuals, and let's boil it down to registered investment advisors to provide any sort of advice, recommendation, analysis, even thoughts, there has to be the ability for them to do so. And the ability for them to do so starts at their own firm. And sure, many of them are working on the demand side. And I think many investment advisors are talking to their firms and going, I am seeing people that are leaving me. I've been their family's investment advisor for many years. And now people are going elsewhere because they want to buy Bitcoin. And they don't necessarily want to buy Grayscale at a 30% premium to the NAV. So what are we doing about it? And many of them are going, well, not only can we not even do about it, we don't even know how to allow you to advise on this, because it's not part of your examination for your Series 7. Every other asset is in there, including probably Nike shoes like Air Jordans and stuff like that, but not crypto. So there's a lot of work to be done for the compliance side and the back office side in order to allow the registered advisors to actually talk about crypto to their clients.
And if I could just interject real quick, Greg, there's actually another part of that as well, where we talk to some firms and they say, we don't see crypto clients coming to us, and they're unwilling to invest until they see that. And it's kind of a chicken and egg situation. I make the analogy to a Ford mechanic that doesn't see Porsche owners bringing in Porsche cars to service, so he doesn't learn how to work on them. Well, there's a Porsche mechanic a mile down the road that's making tons of money on servicing the Porsches and advertises it. And if the firm is waiting for crypto clients to come to them to actually spool up on everything like that, they say, we don't see the clients. Well, there's a reason, because the clients don't see value because you haven't invested and talked about it.
Mm-hmm. Yeah.
Great. Thank you, gents. So I want to look at crypto investment through a different lens. And we referenced this in one of our prep calls, and I think you've all seen the news. What does the investment landscape look like? And again, nothing here is recommendations. When we begin to see public companies or large scale companies holding crypto in their treasury account, holding it on their balance sheet, holding it for a variety of reasons. And we could have really complicated accounting conversations around whether or not it's an intangible, long-lived asset or something, which shows you I spend way too much time with accountants. But there really is an investment perspective on this. What happens when the micro strategies or the larger companies, and following on the news of PayPal offering crypto to institutional and retail investors, for example, what does the investment landscape look like in that context? And let's, Kel, we've got you on the screen. Why don't we start with you? You and I have chatted about this before. What are your thoughts?
Well, I think it's interesting when it becomes material. I mean, if you look at MicroStrategy, they did what they ended up doing 2 tranches for $425 million.
Yep.
And that was what, 2 months ago?
Yep.
So it's probably north of maybe $700 million worth of Bitcoin. Square reported that, their Cash App did what, 1.6 billion in the previous quarter, and they went ahead and acquired 50 million for their treasury. I think it legitimizes things, and I think it forces the infrastructure for the accounting, for the valuation, for everything around it. I think it's good for the entire environment. I think that is as powerful of a market endorsement for crypto assets being held as the OCC ruling on having banks do that. So I think it's huge.
Richard,
I'd like to offer a slightly contrary view. I don't disagree with you, Kel, that it's interesting, but I'm not convinced at this point that it's a driver to mass adoption or even investment thesis, because it is part of their treasury management or FX management, if you will, and it doesn't necessarily change other behaviors. It may do. A couple of things to say about this. I've spoken to merchants and payment providers who have already been using things like the Ripple network or using Litecoin as a means of payment, etc. Most of the merchants they're supporting simply liquidate the crypto into fiat. They're not holding. So it's purely a transactional platform. If they begin to hold that crypto as part of their own corporate treasury and FX management, fine, that would be interesting. And then on the PayPal piece, I'm a little cynical because wasn't PayPal part of Libra, but then they pull out of that. But the other thing is, for PayPal to get mass adoption, they're going to have to really, really reduce their fees and reduce their redemption times, because at the moment the comparison would be with their fiat transaction fees and withdrawal times. Why would you suddenly tie up crypto into PayPal? That's just my slightly cynical view. If they get around those challenges, maybe it becomes interesting.
Rory, I'd also give you with the PayPal item, because you're technically not holding crypto as well. As you peel back the layers of understanding, it's basically have an IOU to you for crypto, which purists will have a problem with. I think there's some challenges there as well. Richard, I did want to give you a little bandwidth as well. Sorry.
Yeah, so I think the PayPal thing is huge. The amount of people out there that have the PayPal out and now can hit buy Bitcoin and have own Bitcoin, quote unquote own Bitcoin is tremendously increased by this move. I think it's a brilliant idea by Paxos, and I think they're going to get a lot more. I think they did Revolut as well. I think, crypto as a service is a kind of a massive new marketplace. And I do think it's going to spur retail adoption primarily. You mentioned, just to kind of pick up on that point, you mentioned they're not actually owning crypto, they're just owning an IOU. That's kind of what happens when you use Coinbase as well, right? They're all the same, unless you actually have the keys yourself. One thing we're not talking about here is crypto adoption in terms of as a payment rail. Speaking of PayPal, maybe think of this. So, everyone's, the use case is a store of value right now. I think a lot of people have even stopped talking about it as a payment rail because of the fees, which I think Roy just alluded to. I'd love to see us get to the point where we can do, where it has some other use case than this. Remittances, certainly that does seem to be a bright spot here. But the fees are one thing in using crypto for payments. And the other thing is, of course, the accounting treatment, which I think is just going to kill it. It makes it so impossible. So if that were to change in some way, and we could have another use case, then really it really could be to the moon at that point.
Richard, I suspect you're alluding to the fact that the IRS gives out FAQs in the United States and continues to think of it as property?
Well, if you bought Bitcoin at one price and then you exchanged it for a cup of coffee, that's you got to pay taxes on whatever the difference is between those two prices. So that's ridiculous.
And we've put forward the WSBA de minimis exemption proposals to the relevant authorities as well. Kel, anything you want to add? And then I want to round out this panel and then open up for QA. Obviously, for all of our attendees in the audience, please continue to submit your questions. We've got a whole bunch of them. But before I do, Kel, any thoughts on that? And I know you and I've talked minimum exemptions, de minimis exemptions previously.
I actually am a little more ambitious than that as well. If you look at some of the European regulations, there are statements and allowances for stable coins that are backed one-to-one with fiat for being classified as e-monies. And with the recent OCC and SEC rulings around stablecoins and holding reserves for stablecoins, and stablecoins are not securities, I think there may be a pathway for one-to-one backed stablecoins to have an exception, or there being no gain when being used for payment mechanisms. Because if you think about it logically, if there's a data packet on the Visa network that represents $1, why is that different than a stablecoin data packet on a blockchain that represents $1? If they're one-to-one, they're backed, almost like a junior CDBC, central bank digital currency. I think there's a pathway there, and that's my hope.
Great, thank you, Kel. Thank you, everyone. So let's start rounding out this panel with the obvious questions and concerns around regulation and legislation. And certainly, Rory, over in New Zealand and kind of the Asia Pacific rim, Greg, your perspectives on Canada, the UK, and Europe as well. But Kel, let's stay with you for a moment. We've gone through quite a bit here in the past year from a regulatory perspective. We talked about the OCC and Brian Brooks and his kind of series of very innovative proposals for banks. We've seen a lot of state charters. Wyoming obviously comes to mind. Let's weave in the politics there, right? Are we thinking that an SEC, frighteningly, but are we thinking that an SEC under a different administration changes that tempo, changes that tone? Will they be thinking about DeFi? Will they be thinking about shutting down some of these initiatives? Do you have any perspectives on that? And let's go through the entire panel. But Kel, let's start with you.
I hope not. I do think that the chances of Hester Pierce becoming, leading the SEC are minimized. I think the recent nomination to make Brooks permanent is going to also be eliminated. So those are two kind of linchpins that, due to the administration change, will not happen. Now, I think it's Grassley is coming in and is a crypto proponent, but as an advisor to the administration, I'm not sure exactly how far or how fast or whatever. I think we may lose a little momentum with Brooke and Pierce, but I think the momentum that started is huge, and I don't think it's going to stop. I think the blockchain caucus as part of the Congress will expand, and you see it on both sides of the fence. And I think that's good for everybody. I was actually part of the effort to get crypto donations allowed by the FEC back in 2014. And so all politicians love donations, and I think they appreciate crypto, and it will be interesting to see how it goes forward.
Great, thanks. Before we go to Greg and Rory, Richard, you being pretty deeply involved in the space, stateside at least, and all the work you've got to do with FINRA, your perspectives on kind of the regulatory landscape and how that might evolve would be great.
It's certainly changing. I mean, Jay Clayton has been notorious, no secret, notoriously hostile to crypto and blockchain even throughout most of his tenure. And then, he surprised everyone in that interview with Brian Brooks, where he came out and said that maybe one day all stocks could be tokenized. So I think there's a change in regime coming. Yes, unfortunately, Hester Peirce won't ascend. It'll be a Democrat or a Biden nominee anyway. Nevertheless, I think there'll be a more open approach, and my bet is we'll see probably a Bitcoin ETF in the next 4 years.
Great. Greg, from the perspective of Canada, you and I have had this conversation a lot, and I know you did spend some time in UK and on the continent as well. What does this look like from the outside? And what are your thoughts from a Canadian regulatory perspective?
For better or for worse, Canada tends to follow the United States. As I mentioned before, being in Canada is like having a really nice apartment over top of a meth lab. So it's a bit of a, we do tend to have to follow along. What I am seeing though is a couple of particularly interesting things. One happened about a year ago, and then most recently, and this is in regards to Bitcoin funds, closed-end funds that are registered and listed on the exchange. And I get that this is not, the crypto thing that we wanted to get to, but at least it is allowing people to participate and allowing investment advisors to sell the product. Now, what was interesting is that the first one, 3iQ, had to go through a series of hearings with the Ontario Securities Commission in order to get this done, because they were initially refused. And they went right up to the top commissioner to get it done, and they were successful. And they spent several $1 million in doing so. The other day, as I mentioned, Galaxy filed a prospectus, largely the same. Of course, piggybacked. What was interesting is that when 3iQ filed their prospectus back in January, there was only one broker dealer on the prospectus, and it was not a bank-owned dealer. It was an independent dealer. It was a large one, but independent. On the one filed yesterday with Galaxy, CIBC, BMO, Canaccord, which was the one that was on the first one, and several other dealers. But more telling was the presence of 2 bank-owned dealers. And that was pretty interesting in the sense that, now they're coming to play. They realize that there's demand, and there is also very likely to be the allowance by the investment advisors to actually sell the product. Many broker dealers could not sell it. They could not solicit orders or even discuss it. They were not allowed to by their compliance departments. So we have this in respect of the UK. Recent rulings there, or recent guidance by the FCA has put different coins or different tokens in different buckets. I can't remember them exactly, but we'll get there. Europe is continuing to press ahead, ignoring basically what the United States does, and with good reason. Germany is very likely to have from what I'm told, a fairly comprehensive a regulation sometime next year on not just crypto, but digital assets in general, and that probably links back to the EU and some of the other initiatives at the EU. Some of them good, some of them not so good.
Great, thank you, Greg. And Rory, and again, Brave New Coin, we're privileged to have BNC as a partner of the Wall Street Blockchain Alliance. And you are a global provider, but I suspect you have unique Asian Pacific Rim perspectives. Anything you want to add to that?
Yeah, I'll talk a little bit about Japan, but just on the FCA, I was really surprised, not overly surprised, when they basically banned CFD for crypto, largely around margin lending. It was interesting because I talked to the FCA about 2 years ago in London. And at that time, they were still deciding whether or not crypto was within their regulatory perimeter, as they call it. And they had decided pretty much that it wasn't, but then they obviously saw that there needed to be some retail investor protections. And that's probably why that ruling on CFDs came out. I think in terms of markets outside Europe and North America, Japan, from a regulatory perspective, has been the most interesting. Japan was the first advanced economy to recognize crypto as a legal form of payment, not a legal form of tender, but of payment. They've obviously had an earlier regime around crypto exchanges and brokers, and they even had a sort of self-regulating industry model there under the FCA through the Japan Virtual Currency Exchange Association. Unfortunately, soon after they started awarding licenses, there was the coin check hack, and then they had to pull back. And from people we've spoken to in Japan at length, the FSA was frankly pissed off, excuse my French, that the industry hadn't got their act together, because they'd been giving them all this leeway to do things. But what it has meant is that no tokens or coins or cryptos can be listed in Japan, not just because they're securities, but there's a prescribed list. So you have to be on the approved list before an exchange can list them. What that has meant is that there's less variety, diversification, but there are core assets that are trading, and there's obviously a huge retail market there. And then the final thing with Japan is they took the decision that just because you're an existing broker dealer in equities didn't mean you automatically got the license to manage crypto. You had to demonstrate you had the capabilities to manage crypto assets. And I think that was quite interesting, because they see them as slightly different asset classes or different regimes, different requirements. And so I think I haven't seen that to the same extent in other jurisdictions. I may be wrong about that.
Great, thank you, Rory. So we have a whole bunch of questions. I do want to reserve the last few minutes with the panel to answer some of these questions, and then we have our last poll of the day. But why don't we first move these questions out there? Some of it touches on earlier topics from the panel, but one of the questions, when do you think the pension funds will jump in, and what are those key tipping points? When is the estimated timing? I know we addressed this a bit early. If you want to give a real quick kind of estimate, Rory, we've got you on screen. Why don't we start with you, and maybe we'll go through the rest of our panelists.
Well, I remember having a call with the Ontario Teachers Pension Fund probably 3-4 years ago.
Hey, cutting my grass. What are you doing talking to Ontario? Come on.
We're a global company. And basically they wanted to really be clear up front. They weren't looking to invest or take positions of exposure to crypto. They just wanted to do the groundwork and do the research. Now, where that's got to, I have no idea. Look, the ETF is possibly one way that an institution might invest, but it's got to be an institutional grade ETF, not a retail advisor distributed one. So that's the first thing. And then the other piece is still the custody. Until that's resolved, they're not going to be particularly comfortable. But hopefully, either from a technology or regulatory or compliance perspective, that gets resolved. Then I think it becomes an easier path for them. You know, the 5% allocation, whether that's of their whole portfolio or their alts, I'll take that. Right.
Kel, anything you want to add?
I just reiterate on the custody. So that's been around a while. So back in March of last year, there was a question put up, for questions around settlement reporting and everything like that around digital currency, digital assets. And that was brought up by Karen Barr, who's the president of the investment advisors. And that's the same question and set of questions that was referred to recently through the Wyoming. So that's been in presence for about a year, where they're trying to figure out what does settlement look like, what does accurate reporting, what does surprise examinations look like. We commented on that, and so did many other vendors and people involved in digital assets, but the SEC still hasn't come out with completely clear rules on that.
Kel, let's stick with you for one moment, and then I do want to give the rest of that question to Greg and Richard, certainly, because a lot of the questions were custodian questions, right? This idea of true institutional grade custodian. And I think a lot of those questions are geared to, at least stateside, Kel, this idea of the old qualified custodian rule, the SEC qualified custodian rule items. What's missing in this space from the perspective of custodian? When someone in this space is saying a true institutional grade custodian, what fills in those blanks?
Well, so do you have accurate reporting as to price? Do you have, are you truly acting and have security, and are those assets that you're holding on behalf of a customer actually secured? are you custodying those in a way that, meets all standards, and what are the standards for crypto? I think we can probably get there with Bitcoin, maybe Ethereum, but there's lots of other ones where it's not clear, where you can't do things like digital signing and things of that nature. The other thing is part of the unique public-private key capacity there is that you can prove you have the keys, right? You can't prove that other people don't have the keys. So there are some fundamental issues that need addressing, and I think at some point they're just going to have to say, this is what we're going to do, here's the testing for it, and come out with it. And I think it should happen within the next couple of years, given the adoption rate.
Great, thank you, Kel. Greg or Richard, anything you want to add to that kind of custody question or beyond?
So I don't think custody's got anything to do with pension plans getting into crypto. We're not exactly spring chickens here, but I'm guarantee we'll all be pensioners before the pension funds get into crypto.
What?
There's no appetite. The best you're going to get is them allocating to a Pantera or an Andreessen Horowitz or something like that.
Yep. Yeah, I'd agree with that. Synthetically, in some way, shape, or form, will be the way they'll stick with it.
Great, thank you all. So let's make this the last question, and then I want to hit the poll before the end of our session. Thank you all for being here. Anyone who has a question submitted that hasn't been answered, please email us info@wsba.co. We'll get that in front of our panelists as well. This is an interesting one for some of us who've been in the space for a while. And the question was, to what extent do you think the regulation of money market funds is a model or reference point for regulation of things like dollar-backed stablecoins or currency-backed stablecoins? And it feels like it brings me back to the money market funds in the early conversations of STRIPS and all of these other interesting acronyms. Greg, I don't know if you want to opine on the money market fund perspective.
I'm going to pass on that one, Ron.
Okay.
Thanks.
Greg or Richard or Rory, any thoughts on that kind of money market fund model?
My only thoughts are going back to ARCA, who have that treasury fund, which got approved by the SEC. It's a security token. It's on the Ethereum blockchain, but they do have in their prospectus that they wanted to leave open the option of including Bitcoin and perhaps other crypto assets in that money market fund. I don't know I don't think they're doing it now. I don't think it's planned in the near term. But that's kind of my only thoughts on the topic. I think the question is about regulation of money market funds, which I don't know too much about.
Understood. Great. Thanks. Kel or Rory, anything before we move on to the last poll of the day? And thank you all for your time. Man, everyone drops off when we talk about money market funds. So thank you all for your expertise. You are all friends and colleagues. I've had the privilege of working and speaking with all of you for a while, and it's always been great. Let me bring up the last poll of the day for our audience. It might be a bit provocative, but heck, we had to go there. By the end of 2021, the price of Bitcoin will be closer to what? And again, none of this is an investment advice or recommendations, but I would love to hear directly from our panelists. We've got you on screen, Richard. Where's it going to be? Oh, I think you're on mute. There you go. Let me unmute you. Let's move forward real quickly. Sorry, Richard. There we go. Richard, you back?
Yeah, back now. Good question. Because we're kind of in the middle right now, so it's a very well done question. So will we be over 25,000 by the end of 2021 is really the question. I'm gonna go yes.
Yeah. Rory.
Yeah, I think so. I mean, this current bull run is again different to all previous ones. I think it'll be supported, but there may be some correction with the Chinese mining issue.
Excellent. Mr. Kell?
Price is right. I guess I would go, I don't know. I'll go with the Citibank answer, which was what, 318,000?
That wasn't the choice, but we'll go with that.
That's what Citibank said.
Mr. Greg Murphy, your thoughts?
I have no idea, and why would anyone listen to my opinion on this anyway?
Wow.
Because that's not my gig.
Well, I appreciate the candor. The majority of our attendees think 50,000, so I'm going to go with that. So we're approaching close to the end. Any last comments for our panelists? Anything you want to add? If there's any open questions, we'll get to them separately by email, but anything you gents want to add at all?
If I can just add one thing around, the infrastructure, a big issue is still around scaling. We've seen that with DeFi and costs of gas. So I think next year we're going to see the layer 2 protocols really take off, and they won't be exclusively for DeFi. They will simply be for faster processing and transaction efficiency. So watch that space.
The word infrastructure always gets me in trouble, Rory, but thank you appreciate those final comments. There's a lot of work to do there. Thank you all for being part of this panel. Thank you all to our attendees. This is our last official event of the year before the WSBA's virtual Christmas or holiday party on December 18th. So everyone, please stay tuned. And that's it for now. Have a great day. Have a great evening, everyone. Cheers.
Thank you, Ron.
Thank you. All right.